Now, let us assume that we are able to somehow maintain an average minimum win percentage for a particular reward to risk ratio setup. Let us just assume that that is possible. Okay, let us just assume that we are magically able to achieve an average minimum win percentage for a particular reward to risk ratio setup. Now, if that is possible, does this now guarantee that we are able to trade for a living and be consistently successful and profitable over the longer term? In other words, will it ensure survivability as a trader? Well, the answer is no. Okay, because even if we could control the minimum win percentage, we still have absolutely no control over the distribution or sequence of wins and losses. Okay, so this is a very important point. And a lot of novice traders or beginners, they don't really account for this phenomena. And this is merely a consequence of randomness affecting our system. Nothing more than that. Now, the win-loss distribution refers to the pattern or sequence of wins and losses experienced by the trading system. Okay? Of course, the worst possible pattern or sequence that any trading system can experience would be a string of consecutive losses. No trader ever wishes to experience consecutive losses, okay? All right? Especially if it's extended, okay, over a tremendous amount of trades. Now, let us look at this in a little bit more detail. Okay, now, as I said earlier, let us assume that we are able magically to somehow control our minimum win percentage and keep it at a certain percentage which is supposed to ensure profitability in the long run. So let us assume now that we have a particular trading system whereby the minimum win percentage required just to break even is 50%. Okay? Now, let us assume that we are able to maintain 50% all the way. All the way, okay? But this doesn't mean that we are able to survive as a trader. Particularly if you do not have enough trading opportunities or what we call trade units within the trading system itself. Now, trade units simply mean the number of opportunities that a trader has in order to take advantage of the market. So what I mean by that is, for example, let's say you risk 1% of your original capital per trade, for example. Now, this will give you 100 trading opportunities, or what is better referred to as 100 trade units. So if you risk 1% per trade, you will only have 100 opportunities or trade units before your system crashes. And again, if you risk 5% per trade, you will only have 20 trading opportunities or trade units in order to take advantage of the market conditions. So let us assume a very typical percentage allocation per trade as used by most beginners out there, which is around 1% per trade. But of course, you will learn later on in the course that 1% per trade is not really viable in the markets, okay? It is a risk that is too high, way too high. But again, that also depends on various factors, like the size of the wave cycle, or some traders like to refer to it as the time frame traded, and so on, okay? But generally speaking, the lower the risk, the higher the probability that you will survive as a trader in the longer run. So let us look at this slide in front of us now. So let us assume that we are able to maintain 50% all the way, okay? And we allocate 1% per trade based on our original capital. So therefore, we have around 100 trade units or trading opportunities. So let us assume that we have one win and one loss. Well, so far, everything is under control. Overall, we still have a 50% win rate. Now, let us assume that now we have 10 losses and 10 wins over 20 trades. Again, we still have a 50% winning percentage. So that's fine. We are still able to stay at break even. Okay? Alright, so that's no problem. The system is not a losing system at this point. It is just at break even. And now, let us assume that in the next 100 trades, we have 50 wins and 50 losses. Again, this is not too bad because it still represents a 50% winning percentage. And therefore, up to this point, our system is still at break even. So that's no problem. It has not turned into a losing system yet. And now, let us assume that if in the first 200 trades, for example, we have 100 wins and 100 losses, although that still represents a 50% winning percentage, which by right should keep us at break even, it really depends on the sequence of wins and losses in the system. So let us assume, of course, the worst case scenario where if the system experienced 100 consecutive losses, okay, in the first 100 trades, for example, that would deplete the entire system of all trading opportunities, because risking 1% per trade gives a system only 100 trade units or trading opportunities. So if this occurs first and the following 100 trades are winning trades, which again overall gives us a 50% winning percentage, that will not be of any use to the trader because his system would have already crashed because the trader has already used up all his trading opportunities. And there is no possibility of trying to recover lost capital unless more capital is injected into the system, which means the trader is topping up. Now, you never want to top up a trading account after such a loss until or unless you have figured out why, or at least to some degree why, the system has lost. Of course, we can carry on with this argument and look at the first 2,000 trades, whereby let's assume that the first 1,000 trades are mostly losses. Okay, mostly losses. That will give any trading system a tremendous challenge in trying to stay afloat. Because although over 2,000 trades, the winning percentage is still 50%, the sequence of losses, if it occurs much earlier in a trade, and it's at an overwhelming amount, far greater than the amount of trading opportunities that the system actually has, then this will pose a threat to the system. A very real threat to the system, okay? So we see from this slide, just being able or just having the ability to control the winning percentage or to keep the winning percentage at a fixed level doesn't really ensure or guarantee that a trading system will succeed in the long term, because that particular trading system and the number of trading units it has is also impacted by the win-loss distribution pattern. So this is a very important point that a lot of beginners fail to recognize. Some professionals as well, actually. Because the main problem is that a lot of beginners adopt a best case scenario approach when trading the markets, and this is fatal. The proper approach when trading the markets is to adopt a worst case scenario perspective, and from there we are in a much better position to handle risk within the trading system. Let us now look at one last example. Let us assume that now we start with $100 in our trading account, and we have a methodology whereby our average percentage win is around 54%. We also have a setup whereby this is the reward to risk ratio. Here we see that our reward is 0.94%, whereby the risk is 1%. Don't forget, this is in ratio form. So let us see the performance associated with this system under a Monte Carlo analysis. Now, a Monte Carlo analysis is nothing more than simply trade simulations, usually executed over a tremendous amount of events to give a more realistic performance measurement of how a system may perform in the real world. And this is one of the most powerful forms of analysis that a technical trader can actually employ. I've already run the simulation, and this is what we have based on this setup, okay? So here we have an initial capital of $100, and looking at the mean performance or the average performance, we see that this is a winning system. Okay, if you follow the black dotted line here, that represents the mean return of the system. And we can see it is rising over time. It is rising over the number of trades being executed. So this tells us that this is a winning system. On average, don't forget, this is the mean performance. Okay, so on average, it is a winning system. So most traders should expect, if they can maintain the minimum win percentage or the required winning percentage, they should find that their system is a winning system and that it generates capital over time, on average. Now, I've used the phrase on average a lot of times because there is a specific reason why I'm using the word average. And that is because we must account for the effects of randomness in the market. Now, this is a very interesting chart because we see over here, over a simulation of around 5 million trades, which will give us a very accurate picture of how this particular setup will perform over time. We see that the maximum performance, statistically possible, rises at a much greater rate than the mean performance. So that's fine, nothing strange about that, because after all, it is a winning system based on the mean return performance here. But the problem is this. Notice the minimum return over time. The distance between the maximum and minimum represents the range of possible outcomes that any particular trader may experience trading this particular setup. So this is quite shocking because as time passes, there will be a larger or growing amount of traders which will experience loss trading this same setup. Can you see that? Although we have a larger probability of being successful in this system over time, okay, because as you can see, the maximum as well as the mean return performance is rising over time above the initial capital level. Okay, we can see that. But there also exists a group of traders which will experience loss over time, trading the same setup, the exact same setup. Can you see that? And this, as you can see, is also growing over time. So the area between this minimum red line here and the $100 level, this space here in between the red line and the $100 level represents a group of traders who experience loss trading the same setup as the other guys. So this is very shocking because for a particular setup, statistically speaking, there will exist two groups of traders. One group will be basically having a winning system over time, and another group will be faced with losses over time. So in short, based on the exact same trading system, one group of traders may experience success and another group may experience losses. This is merely a simple statistical outcome, and this explains why certain traders using a particular system seem to continue to make money all the time or be successful or consistently successful all the time, while another group of traders using the same identical system experience losses instead. So, therefore, just having positive expectancy alone or being able to maintain a certain winning percentage within your trading system does not necessarily guarantee that you will have a winning system. This is shocking news. Because according to the standard mathematics, okay, without any statistical analysis, just using standard linear mathematics, for example, if you are able to maintain the required winning percentage within your trading system, you should be able to predict whether you will be successful or not using that particular trade setup by just doing the simple expectancy calculations. It's all black and white because the simple expectancy formulas that we all use, be it linear or non-linear, does not account for the statistical properties that is associated with trading in the real world, where randomness is a big problem. So therefore, this means that over time there will emerge essentially two groups of traders, one successful whereas the other is not. based on the same identical trading setup. Immediately, we see that this is totally counterintuitive, since both groups are using the exact same trading methodology. So how can that be? Doesn't make sense. And this is where the beginners get completely clueless about what's going on. So instead of trying to find a way to resolve or at least to mitigate the adverse effects associated with randomness, they instead resort to optimizing technical parameters, backtesting other oscillators or indicators, and that kind of stuff, which again does not solve the problem. Basically, they're just looking for a new setup without knowing that whatever new setup that you employ will also be subject or susceptible to the same statistical outcome that impacts any trading system in the market. So we cannot look for a solution within the realm of technical analysis. We got to look for a solution that lies outside the realm of technical analysis. Even if we are able to fulfill the minimum average conditions necessary for a potentially successful and consistent setup, we may still be unable to ensure success as a technical trader, especially over the long term. In fact, many traders may experience a consistent and gradual drawdown in capital caused by the statistical effects of randomness on the trading system. Okay, you can read this slide on your own because I've already covered this in my discussion just now. But just pay attention to this particular paragraph here where it says that even if we could control the minimum win percentage, we still have no control over the distribution or sequence of wins and losses, which again represents the effects of randomness on the trading system. And therefore, as I said earlier, just having positive expectancy alone is not enough to ensure long-term survivability as a trader. So what are the solutions? Well, we don't have to worry about that too much at this point because we are just at the introductory stage of our masterclass. But again, it is good just to summarize what we have seen so far. And what we have learned is that some challenges in trying to apply technical analysis or technical trading systems in the market effectively requires a solution that is beyond the realm of technical analysis in order to resolve or mitigate the issues faced. And again, let me just reassure everybody, don't get too worried at this point, even though the challenges that I've presented looks fairly insurmountable. Okay, but let me assure you that we shall be looking, or we shall be examining the degree of resolution possible in more depth and detail with respect to these challenges in later video modules. Okay, so for now, just relax, don't worry too much about all this. I just want you to get the feel of what I'm saying. And with that, I will see all of you in video module 3 and beyond. Thank you so much for watching, and bye-bye.